Hello, everyone, and welcome to today's webinar. My name is Bree Reynolds with FlexJobs, and we are really pleased to be hosting this webinar with our partners at Prudential Pathways on managing day-to-day finances during the coronavirus crisis. So we do have some housekeeping items to get to, and then I'm going to introduce our speaker today. So the first thing is this is going to last about 1 hour, and we will have Q&A with the audience. So we'll be taking your questions, and we're going to kind of intersperse those throughout the webinar. So we'll be able to answer questions as we go. So if you have questions, please put them in the Q&A section on Zoom. There's also a chat section, which you can chat with people back and forth on who are also audience members. And if you have questions of myself or the panelists, you can put them in there, but the Q&A section is really where we're going to be looking for questions. You can also vote up questions too. So if you see someone else's question and you think, oh, I also had that question, I'd like to have that answered, you can thumbs that up and we will see those rising to the top. So feel free to put your questions in the Q&A area. We won't be able to get to everyone's questions, of course, but we will try to answer as many as we can. This webinar is also being recorded, and a link to view the recording will be sent at the end of this week. And after the webinar, there is a survey that will launch automatically where you can leave feedback, which will be very helpful for us. And if you'd like, you can also sign up for a complimentary one-on-one financial wellness assessment with a Prudential, Pathways specialist. And there's going to be more information on that throughout the webinar as well. But now I want to introduce our partner here and our speaker from the partner. So Prudential Pathways, for those of you who are unfamiliar, offers practical, down-to-earth information that may help you and your family today, tomorrow, and beyond. It's really designed to give you a good understanding of the fundamentals of financial wellness through educational seminars, just like this one. And today's presenter here with Prudential Pathways is Emmeline Singh. She's a financial planner and an education program speaker at Prudential Pathways. Emmeline is super passionate about providing clients with the tools and education they need to navigate life's financial challenges. And she has nearly 20 years in financial services, including over 2 years at Prudential. Emmeline recognizes that more knowledge is good for clients, and that makes them more empowered and confident in how they feel about achieving their goals. So we are very happy to have Emmeline here. I'm going to be taking notes during this webinar, and I'm sure you all will as well. Thank you, Emmeline, and take it away.
Thank you so much, Bree, for that. And thank you all for attending and taking time out of your schedules. And especially in these times, it's a little bit different. Normally we'd be somewhat in person and also online, and now it's just online. So bear with us if we have any glitches or anything to do with the presentation. But I just wanted to welcome you all. And first and foremost, on behalf of FlexJobs and perhaps on the side of Prudential, we just hope that everybody that is close to you, loved ones, family, friends, everybody is doing well and is healthy. And besides the pandemic, we hope that all else is going well. I myself, like we said, I've had about 20 years in the industry so far. And I moved over to Prudential a couple of years ago, primarily because I have a 9-year-old daughter and I'm a single mom. So I needed the flexibility of time that I really wasn't getting beforehand. So this also gives me the opportunity to not only present for Pathways and also help clients and continue financial planning, but it also gives me the time and flexibility I need to have a home work-life balance, like most of you. So I'm really excited about everything today because I think we all have a lot in common. One thing we also wanted to address today was, even though we're going to be talking about how to manage day-to-day finances during COVID and even after COVID, one thing that we do stress is we hope that some of this information that we're bringing for you today, or some of the highlights that we can kind of tune you into, will help you not only to maybe take a look at how to manage finances better, but also sometimes deal with anxiety better or deal with the unknown a little bit better. We do stress that mental health is just as important as your physical health. So we do want to help you with that as well. So with that being said, again, I'd like to thank FlexJobs for letting us come on board and kind of giving you this presentation and giving you the information, the tools you could use. So with that, we'll continue on to the presentation. Everything will be pretty much presented in a general broad-based view. We're going to give you an overview of a lot of the different tools and techniques you can use. And like Bree said, we will be offering one-on-one consultations at the end if there's something very specific you want to go over or something that's related to your life. So we will go through that. And as we go through this, if you have any questions, feel free to throw them out there as they come up so we can be more clear and we can expand on certain topics. Or if there's something just that you feel might be a question that you have for yourself, you can go ahead and we can answer that a little bit later on. All right, great. Again, thank you all for joining. One thing that we do take a look at when we're looking at the coronavirus, the pandemic that we're going through, it's unprecedented, right? And for the first time in pretty much anyone's lifetime, the world is going through it together. And that's causing a lot of uncertainty because generally, even if we're having a bad market here in the United States and in another country might not be going through that, we can kind of pull and take a look. The global hemisphere kind of works in different ways. This is the first time that everyone globally is going through the same type of issue. One thing that we worry about is not only just staying healthy and taking the right precautions. And if you have children, you know, that's also sometimes you're working from home and now you've become a teacher as well. And like I said, for a lot of us, it also can cause a little bit of anxiety or a little bit of short-term panic. Just think about where is that next paycheck coming through. If you have a partner or a spouse that's helping you with the household finances and they could be laid off or furloughed, or they could have their hours cut, or, you know, something that was coming down the pike work-wise can now be either put on hold or even canceled. It can cause a lot of that. So we're hoping what we talk about today can help you offset some of the questions, concerns, or issues that you might be facing. So when we take a look at it and we take a look at what is bothering people, you know, a lot of the United States is in different pockets. We have certain pieces on the East Coast and the West Coast, different types of career jobs. They all pay very differently. You have the Midwest. But for the first time in a long time, Prudential did a survey in February before Corona really started taking hold. And 54% of Americans said that they were not financially prepared for a disease or some outbreak to happen where now not even where that next expense can be paid from. And you have savings, as we'll get into, you know, one of the main concerns with savings is how much is enough and do we have enough? So we hope to kind of go over that as well. One thing that we do consider a very helpful tool, and technology has lent itself to really helping a lot of us through this coronavirus and the pandemic, because there's a lot of applications, a lot of tools that you can use online. You know, you can manage your accounts, you can manage your banking and your finances, whether it's your investments. And the good thing is a lot of this can be done through your phone, through iPads, laptops, anything that you use on a normal daily basis. A lot of banking institutions, financial institutions, in general have been limiting how much they're willing to help you with over the phone, how much they can help you with in person. So a lot of these tools and applications that people are using now are helping you pay your bills, transfer funds, look at your historical credits and taking a look at your debits, taking a look at, you know, all of your accounts. Sometimes all in one app, you can include all of your accounts and take a bird's eye view as to what do you look like financially. Some people also have taken it a step further and taken a look at saying, what does my credit finally look like? My credit score, you know, when we're working day to day, time flies, and sometimes we don't really have the time to go through each individual account or take a look at what we really are spending or bringing in. Generally, when you have income and expenses, sometimes as long as you can pay the bills with what's coming in and you can save a little bit on the side, you're comfortable. Now we say, especially with this type of pandemic, and even after this is over, one fear in a lot of Americans is what would happen if it happens again, or what if there's something down the pike that comes and we have to have this quarantine time frame come up again? How do we deal with that again, even if we've dealt with this? So one thing we say is really acquaint yourself with a lot of the apps, a lot of the financial institutions that you use, work with through online apps, really find out what are you spending, what are you making, where does that income go, and take a look and figure out a way to create a plan for yourself, a full financial plan. Because once you have that blueprint, that roadmap, no matter what comes down the pike, you'll be a little bit more rest assured that you can handle that. One thing that we take a look at with your spending plan and why it's helpful to have one is track your spending. And really what that means is over my 20 years, I've had many, many clients. Doesn't matter what they do for a living, doesn't matter if they're single, married. A lot of them will say, I had no idea I was spending this much money or where exactly I was spending so much money. You know, a lot of us say, yeah, we know we shouldn't be eating out, we should make lunches, or, you know, for a lot of you may have a separate ledger for business expenses or for things that you're doing as far as travel or things that are expense. So for you, you may have two different spending plans, one for your personal and one for work-related items. If you have a spouse that might be self-employed or might have a different type of payment plan, you may be taking a look and seeing where's that income coming into play. And it's also something where you take a look and you say, if I can manage my spending, if I can manage my debt, it also helps you curb your impulse spending. So sometimes Amazon has become everybody's best friend nowadays since people have been working from home. And a lot of people even say they've been ordering a lot through Amazon, either because of need. You don't want to go to the stores if you don't have to. Sometimes things are readily available on Amazon, even if it's a delayed and Prime doesn't work. It's not as easy to go to the store and get it done, or people don't want to stand online, or it's just not convenient, especially if you have children in the home. So you can even curb some impulse spendings if you better understand where your income is coming from, how much could be coming through the door, how much is tightened now, as well as what are our essential and non-essential expenses. And then that also helps you find a way to say, how can I save a little bit more and maybe cut out some of the expenses? One thing that's also very important to understand, if you have children at home, and depending on the age of the children, it might be really helpful to talk to them about what's happening, both environmentally and as well as economically. Although you may not tell them every single thing that's going on, you know, they don't have to know every expenditure or every piece of income that's coming in. It might be a good idea to talk to them and say, you know, this is how things looked before COVID, this is it during, and hopefully after, we can take a look at different things. It also helps them feel like they're part of the process, and it also helps them cope with, okay, economically things might be changing. This is, as a family, how we deal with it, so that in their lifetime, as they're growing and they're becoming more financially responsible and aware, they may be able to handle things a little bit better than they would if they didn't know anything, if there's a pandemic in their future. And right now, things are so unprecedented, we have no idea what's coming down anybody's path at this point. So if you have any questions on anything we've talked about so far, please feel free to send us questions. And Bree, if we have anything so far, we can definitely talk about that. Otherwise, we'll just continue on.
Yeah, let's continue on.
One thing that we do take a look. Perfect, thank you, Bree. So one thing that we take a look at is fixed expenses versus variable expenses. And a lot of these, again, for some of us, it's just our household. For a lot of us, it's also, well, I have business expenses and I have personal expenses, and perhaps I even have elder care expenses. Perhaps I'm taking care of somebody in the family, whether that's a parent, whether it's an aunt and uncle, whether it's another niece, nephew, child, whatever the case might be, there might be a separate ledger for that. So one thing to understand is with fixed expenses, it's more about what's essential, really. What do we need to pay to make sure that we can have a roof over our head, food in the fridge? What do we need to pay for? So on the slide, you can take a look. It says mortgage, food, rent, utilities, transportation, healthcare. These all are very important things that we have to cover no matter what. It's things that are essential. Property taxes, alimony, and child support. Alimony and child support can be either income or expenses compared to, depending on what you're paying or what you're receiving. But then you also have variable expenses, right? And this is where I think a lot of families, a lot of households, just people in general are taking a look at and saying, especially if you've gotten hours cut back, income has been reduced into the household, things have been furloughed or put on hold. Things are very important to say, do we need a lot of these non-essential expenses? It was great to have Hulu, Netflix, and all of the rest, but do we really need all of that right now? Can we cut down some basic expenses and really narrow down for now? Vacations, a lot of people, because of COVID, because of the quarantine, but also in coming months, You know, it could have been that there was a little tightening of the budget, so now a vacation that was planned may not be the best financial decision at this time. So a lot of airlines, a lot of hotels, and a lot of booking services are even suspending a lot of their late fees or rebooking fees, and they're even holding reservations until next year. It's a great time, instead of losing anything you might have paid for that or anything that you might have prepaid, to kind of call them, reach out to them, and see if you can extend those vacations or cancel them altogether without any fees. Hobbies, sports, again, a lot of places have been closed. Gyms, different types of sports facilities, they've all been closed. Golfing. It might be a good way to reach out to them and see if there's a way to either reduce or move over your expenses. So if you paid for, let's say you prepaid for a year or 6 months or 3 months, maybe they can add that subscription further out, so you save yourself some pay there. The other pieces are gifts, takeout. You know, a lot of us have been, grocery bills have gone up a lot because people are buying more groceries rather than eating out or going out to restaurants. So it does take a little bit of maneuvering to understand what were we spending before and what did COVID end up making us spend. Also, clothing, right? Sometimes you have, clothing can be variable, but it can also be essential. Like I said, I have a 9-year-old. She's growing out of clothes like crazy. I don't need new clothes, but she does sometimes. So the thing is, it's also very important to note, how much of a new wardrobe do we buy? What new essential items do we buy? What new clothing items do we buy? Gifting especially, there's a lot of ways to send gifts for birthdays or holidays, but one thing to be very mindful of is there a better way to maybe curb that if money is tight in the house and isn't coming in the same way? One thing that we also say is, when you create a financial plan, when you initially put these fixed and variable expenses in that plan, it's very important to revisit and take a look at the landscape and say, are we still spending that way? Do we have to renew any of these numbers? Do we have to take a look at where our money is going? Even when we take money out of the ATM, it should go into the plan of where does that cash go, so we don't lose track. Okay, hope that makes sense so far. One thing that we do say is, you know, LendingTree did a really great survey not too long ago for Americans to say that 44% of Americans are really worried about how are they going to pay their mortgage, how are they going to pay their rent. It lends itself to understand that sometimes, no matter what's been brought into the household as far as income is concerned, if it met the expenses, we were fine, we were calm with it, we could pay our bills. But now that if that income is reduced, or we feel more stress on other bills that are popping up, mortgage, rent payments, even property tax payments could become a big piece of our anxiety. It could become a big piece of the financial puzzle that we have to solve for. This is also why we say it's very important when you're looking at your expenses. If you can redirect some of your expenses that are unnecessary and you can redirect them to necessary bills, sometimes that can help ease where that money flow would come from. Okay. One thing we always say is, if you do feel in your household, or even someone that you know that might be talking to you that says, you know, I feel like financially getting squeezed a little bit, money's a little tighter than it normally was, or there's a fear that, yes, I have my job right now and I have whatever I'm doing right now and it seems stable, but what if in the future there's a shift in the way people do business? You know, right now, many people are online that thought their careers would never be online. So sometimes there's a little bit of anxiety to say, what if the job I'm doing now changes? Or what if I'm forced to do something different? What would happen if my income changes or tightens? And if it's tight right now, or it's something that you're worried about, be proactive. Contact lenders. They're very willing to work, especially with what's happening now. They're very willing to work with you on interest rates, on payments, on even suspending interest in certain cases. There's also a lot that you can do with even the essential expenses. You know, when you have internet and cable providers, cell phone providers, utility providers, they're actually giving you a lot of different programs depending on who you're with and when you call. And they're actually helping a lot of people kind of move those bills around, or maybe even give you more time to pay those bills without any service interruptions. And they're also helping you to figure out if you can curb some of those expenses as well. Maybe they can give you the same service for less money for a period of time. So it's always a good thing to check for, even if right now you're not feeling the pinch. You can also check your credit report. And we always say this is really, really important. One thing you always want to do is you have the 3 credit bureaus. And whether you look at any one of those 3, pull your credit. You're allowed to pull your credit for free once every 12 months. And since you have Equifax and you have Experian and you have TransUnion, which are the biggest 3 credit reporting agencies, one thing that we even encourage you to do is ask each one every quarter for your, let's say every 4 to 5 months, ask each one for your free credit report. This way you get a fresh credit report that you can review, make changes to if need be. If there's something inaccurate on there that affects your credit score, it affects your credit history. So it's really important to know, was there a mistake made? Is there a charge on there that wasn't mine? Is there something there that I need to fix or bring attention to? Sometimes those small little changes can really help you with future interest rates when you go to lease or buy a car, things like that, homes, rentals. So it's very important that if you spread out asking and requesting for your 12-month report that's free of charge and due to you by law, it's really great if you can space them out. You're constantly getting a free credit report that doesn't affect your credit score. So hopefully that makes sense. And it's also a good way to keep on top of everything that your creditors are seeing. One thing you can also take a look is, when are my bills due? You know, for everybody, it was if things were running and you guys were all working and everything was running according to plan. Our new normal, we still don't even know what that's going to look like, really. Things are starting to open back up and things are starting to look great again. But again, we don't know what our new normal is. So some things to take a look at is, when are all of my bills due? If I find that all of my bills are due all on the 1st and the 15th of the month, I may want to call some of those companies and say, do you mind if I move my billing due date to the 25th or the 30th? Many creditors are fine with that. They'll go ahead and move your bills around so that it's more comfortable for you to pay, so you know it's not all at one time. Similarly, the other way around, if your bills are all staggered all over the calendar, you may decide, I want them all due on the 1st and the 15th of the month, because then I know I can pay them all at the same time when my income comes in, and I can take a look and have a clean slate middle of the week. So that's also something to consider. You don't have to have your bills all due at the same time, or they are, just know that it's in your control. You decide when to set those dates. One thing to also take a look at that's really important is making savings a priority. But again, before we go into savings and investing, if you have any questions on anything we've discussed so far, please feel free to send it down. One thing that we look at when saving is making it a priority, right? So for a lot of or matching expense, we don't have a lot. Perhaps we're saving our 401k or SEP IRAs or any of our retirement accounts. Those are really great and they work really well with the savings piece of it. But you should always have money on the side, especially for what we're going through right now. Some of you may have a very good savings account on the side. We do recommend about 6 months worth of expenses to be put on the side. So you should be able to run your house comfortably for 6 months with the money that you have in your savings account. And when it's in your savings account, it's different than having an investment account, because that savings account should be pretty quickly accessible. It should be where if there's an emergency, it should take literally no time at all for you to be able to get your hands on that money. One thing we also say is, if you perhaps stop putting money into a separate savings account, or because maybe there was a little bit of an income reduction, you haven't been saving as much as you should have, and right now it's dwindling a bit, just start small. You know, sometimes if you were paying money for trains, or you're paying money for buses, or there was lunch money that now you're no longer using, redirect that money into a savings account. You know, if I'm not spending money on a train ticket, I may decide to take that same amount of money and move it into a savings account, because normally in my old working lifestyle, that was just an expense I always had. For a lot of people, it's gas money. You know, nobody's been driving as much. And so that's a way for you to just save into savings without really feeling that you're feeling a huge pinch. Again, it always depends on your individual situation. You know, if the income now is reduced to a point where savings isn't an option, create a plan for when that will be an option. How much could you put away? Even a few dollars here and there starts adding up pretty quickly. A lot of people will also take their paychecks or different things, and as you're paying your retirement accounts and putting money away for retirement, and as you're paying bills and things that are necessary, add another bill as your savings account. Make that a priority. move some money into a savings account as if you have no choice. That way, over time, you're not only building up a retirement savings, but you're also building up a just-in-case savings account, like a rain check. So you can take a look at those types of things. One thing we also want to take a look at is investing.
Interrupt just for a second? Sorry. We have had a couple of little glitchy moments with your video, so would you mind turning off your video? I'm sorry. Most of the time it looks great, but just so we don't miss any of the really good info that you're saying, I think that would be extra helpful.
Not a problem.
And
sure.
Sorry to everyone
sorry
watching.
No, we're sorry. It happens sometimes. All right. So bear with me. How does, and perhaps we can even turn it back on later and hopefully it'll be better.
Yeah, let's try that. Let's try that.
Okay.
This is great for now. Thank you.
Can you hear me? Okay. No, my pleasure. Can you hear me okay?
Yep. Sounds great.
Okay. Perfect. So one thing that we wanted to do was, talk about continually investing. Right now, especially with the way the markets have been, they've been really on a roller coaster and we've had a lot of down days. So for those who are looking at their 401ks or retirement accounts or even your non-retirement investment accounts, sometimes that can lead to a little bit of panic because you're watching assets drop quite a bit and it's not something that we're used to seeing, not since 2008. But that's also a really important piece to remember because back in 2008, one thing that we kind of should have learned if we haven't remembered it is when we panic, when we make decisions because we're worried about losing money, sometimes that could hurt us long term. In 2008, if you remember, the markets were going down very quickly, very fast, and there were sharp downturns. But for those who stayed invested, stayed the line, didn't really make rash decisions to sell and move to cash or try to make sure that they weren't going in and out, within a 5-year period, they should have been back to where they were and then even went above where they used to be back in 2007 and 2008. The problem is with the markets is sometimes when we don't have a financial plan that takes bad markets into account, we sometimes panic and sometimes we make decisions, and that's the worst time to make a decision is when you're worried about your assets going down. When you're in the market and you see your money is declining, you see the numbers are declining, please remember you still own the shares. So when those shares bounce back, you should be able to do that. The worst thing we want you to do is sell low and then buy in when you feel like things are doing well, because sometimes there's no such thing as timing the market and you could easily get in and then watch the market have a downturn again. So we always say, if you're managing your assets on your own or whether you're having them managed with a professional, always really understand, are these the right investments for me? If they're not in line with your risk tolerance now, if these investments were investments that you made years ago, you may want to revisit and say, will I be able to take a downturn according to my risk level and what I'm invested in? And that's very important to understand because as the markets can go up and they can come down, rebalancing is very important. If you find yourself where you might question what you own or question if it's a decent time to maybe cut down on some of your investments or move out because you don't want to take that downturn hit, or you're closer to retirement than maybe you were before. And typically, if you're younger and you have longer time frames, we say you should be more aggressive. And typically, if you're closer to retirement, we say we want you to have less of a risk level. That's not always necessarily true, depending on what your financial plan looks like. But again, we want you to take a look at what you own and keep the course. If you feel like you're worried about things, talk to a professional. There's a lot of professionals out there who can talk you through what you're feeling, kind of give you some clarity into the market. The one thing we always say is also, you may want to rebalance. Rebalancing is really, really important, whether the markets are good or the markets are bad. If you, for instance, just an example, if you're 60% in stock and 40% in bonds, and the market drops sharply, your overall landscape is not 60-40 anymore. Your bonds have taken over and your stocks have dropped. So if the market rebounds, you have actually less stocks to do that with. So you always want to constantly rebound, rebalance, take a look at what you own, and decide when's a good time for me to structure this in a way that it's according to my goals, my risk tolerance, my household, but also in a way that if the market goes down, I'm not going to be worried. I'm not going to panic. I have enough time to make this up. And again, if it's something that you're worried about, talk to a professional. or research your own portfolio. It should help you. And there's a lot of, again, different applications out there that can help you do it. And a lot of websites are very, very user-friendly nowadays to help you manage just that. Okay. Again, if you have any questions, please let us know.
And actually, there are a lot of questions coming in, Emmeline, if you would like to answer some.
Oh, great, Bree, if you,
Yep.
Yeah, that'd be great.
Awesome. All right. So let's see. The number one question that we have right now is, do you recommend paying minimum payments on credit card bills monthly?
So this is kind of a twofold question. It's a great question to ask, so thank you so much for asking. If you're in dire straits and, for instance, you cannot put any more toward your credit cards because perhaps the mortgage payment, utilities, all of the essential expenses are really exceeding your budget, please, yes, absolutely, because you just don't want to fall behind on payments on your credit report. So you do want to keep up the minimum. However, it's not ideal. If you can, try to pay off that debt quickly, especially credit cards, because what you'll notice is no matter when you got the card, generally credit card interest rates are not your friend. They're generally very high. And so sometimes if you just pay the minimum, you're literally paying the interest on the card, or sometimes not even that much. And it doesn't help you get ahead. So we always say, absolutely, you know, sometimes even call the credit card company, see if they can work with you on the interest rates, especially during Corona. A lot of credit card companies are understanding that people are not able to pay more than just the minimum, but they're helping people with the maybe perhaps lowering your credit interest rate for a certain period of months, or even giving you some time to catch up paying the debt piece of it. So in general, if you can afford to, in the most ideal world, we would like your balances to always be zero, right? We want you to pay the credit card balance as it comes through. However, in reality, if you can pay more than the minimum, please do so, because that gives you more chances to catch up and paying off that debt rather than being constantly handcuffed to the credit card company for years on end. I hope that makes sense. If I didn't answer your question, feel free to send me a follow-up question.
No, I think that was great. Thank you very much. And we have another question about, let me just scroll up the questions. The questions move every now and then as people upvote them. This came in from a number of people. Do you have any recommendations for budgeting templates, or how people could kind of create a budget tracker for themselves?
That's a wonderful question. So there's so many different websites out there. If you even go on Google and you Google different types, the reason we don't give individual ones and saying this is the best one, you should use that one, is everyone works differently. You know, the way I like to do things in my spreadsheets, they can be very detailed. Somebody else might want a different type of app and a different look to it. And there's so many out there. If you work with a financial professional, financial planner, or any type of advisor, a lot of times they create a plan for you that then they turn over to you in your hands, and you can then manage it from home, and they can manage it when you speak with them. So this way, everybody's on the same platform, and it's easy for them to advise you going forward, and it's an ongoing relationship. And a lot of times, if you have investments, whether it's a 401k, IRAs, SEP IRAs, KEO accounts, a lot of times the institutions that hold those retirement plans for you, they'll offer you retirement planning and budgeting solutions that you can look at those tools and resources and see, is it easy for you to work with? Does it make sense? Do you like working with that app? And if you do, great, use it. And if you don't, again, there's plenty of different budgeting tools. Even if you have smartphones and you look at the different websites that you have out there, different financial websites, everyone's got some type of tool available that you could download right on your phone or right on your computer. And you can even work with those tools on different devices, which is important, because if you're planning with a spouse, or you're planning with a partner, or even if you have a roommate that helps split bills, sometimes you can even set up apps between devices that if I pay a bill and I put it into the app, somebody else knows it's already paid. They understand where we are financially. God forbid something were to happen to the primary bill payer, if you will, of the household, because even though people might be involved, sometimes one person is in charge of paying all the bills and the other one is in charge of maybe scheduling all the activities or different things. If something were to happen to that one person, would the other one know exactly where to go and how to keep on top of everything? So sometimes a lot of these apps being shared between different devices can also help. So there's no perfect answer because it really depends on what do you find easiest to work with. Because the other thing is you don't want something so convoluted, and you don't want a budget spreadsheet or a worksheet or a program that's so difficult to work with just because somebody else might like it, that you don't really work with it well. You don't go back into it every month and update it. You want something that fits your lifestyle. And if you look at the App Store on iPhones or other Android devices, you'll be able to see that there's so many different ones. And again, look at the financial institution you work with or the planner you work with and see if they have something readily available, because most do.
Great, thank you very much. And also, oops, sounds like there's a little bit of feedback there. There's also the financial wellness website at prudential.com/flexjobs that has some budgeting information and tools there as well, just to throw that out there. And I've put the link in the chat as well, so anybody who's looking in the chat, you can see the link there. But thank you very much. So I think probably we could go back into the presentation again and then do some questions in another few minutes.
Yep, and just let me know if there's any more. We'll go from there. Okay, great. So one thing that we take a look at is withdrawing from your retirement account. So let's just say worst comes to worst, dire straits, perhaps income has stopped or just receded so much that it's hard to pay off a lot of bills, or there's bigger bills coming that we just can't put off. So just like you're budgeting and you budget day to day, and we take a look and say, well, what are our variable expenses and what are non-variable? One thing we also have to take a look at, especially if you're a homeowner, I'm sure plenty of you feel like things break all the time or need to be replaced from time to time. One thing that if you own a car or you lease a car, one thing that you may have to always consider a part of your budget is when that lease is due, you may have to put down more money for a new lease. Or if it's a car and you have certain repairs or you want to have to buy a new car at some point, those are big ticket items that we say you should have in your plan, and have a plan to figure out how is that going to be paid when time comes, so that at the last minute, you're not searching for money from here and there because you have to fix the roof or you have to change out the driveway. But emergencies happen, things happen. So sometimes you may be forced to go to a retirement account, and whether it's taking out a loan from a 401k or a plan, or it's making a withdrawal from a retirement account, one thing that we say is please be very cautious, because even though you're taking money out, you can be subject to ordinary income taxes. And so what happens is now you're taking out money, but because you didn't pay taxes when it was growing, they're going to ask you to pay the taxes now. And if you're not 59.5, you may be subject to a 10% penalty. The other piece, so may not be doing as well as we'd like. Your investments may be, let's say, declining, or they may be lower than where they were. The last thing we want you to do is sell low, lock in those losses because you have to take out the money. Because now you're losing, if you remember when we said you still own the shares, now you're no longer owning those shares. So there's no way to gain that back because you've cashed out, even if it's a small amount. The other piece to say is it also impacts your time and ability to retire. You know, one thing that we take a look at is saying, if you take out money out of your retirement account because you have bills now, and again, we understand things happen, but we always say, talk to a tax advisor, talk to a financial planner before you start doing these things, because you definitely want to make sure that there's no other way for you to take money out other than your retirement plan. Also, the other thing is when you do take a look at taking money out of your retirement plan, there's one thing that's important to understand is sometimes the IRS will forgive the pre-59 age 10% penalty. If you're not 59.5, you'll take a 10% penalty on anything you withdraw, plus you owe your taxes. However, generally, if it's a first-time home purchase, or there's health bills that you have that exceed a certain amount, or you're trying to avoid foreclosure, or you have tuition or higher learning expenses, sometimes that, if you talk to your tax advisor, that can offset that 10% penalty, and the IRS will not charge that to you. One thing that's also important to know is because of COVID-19, the IRS and the federal government has put some mandates into place and some provisions that is known as the Coronavirus Aid, Relief and Economic Security Act. It's also known as the CARES Act. It includes loans and grants for corporations and small businesses. It's also for small hospitals, state, local governments as well. However, it's also enhanced unemployment for those that are either laid off or have reduced hours or are on furlough. So they've made getting money a little bit easier for those who are impacted by COVID-19. Now also, the other thing is with this bill, there was about some checks that went out for about $1,200 for a single taxpayer that earned about $75,000 or less in adjusted gross income. And it also provided for $2,400 for couples that, you know, were earning about $150,000 or less. Now, there's a caveat to this. The payments were decided on by your 2018 or 2019 federal tax return. And the reason they did that is because right now, no one's been filing for 2019 since the extension is for July 15th. And then for 2020, even though you're receiving the money this year for 2020 from these relief checks, the IRS will go back and take a look and see when you file your 2020 taxes, were you eligible for the full $1,200 or $2,400 checks that we sent out to you? So in the government's eyes, if they overpaid you, so let's say in 2020 you earned more as a single individual than $99,000, which you had a little bit of that $1,200 given to you, they may ask you to pay some of that back because they overpaid you according to your 2020 return. Similarly, if they paid you some money, and let's say, for instance, your 2018, 2019 taxes that they were looking at was, let's say, higher, and 2020 you earned less, they may actually send you some more money because they owed you a little extra. So just keep that in mind because it's something that many are not aware of. Okay. Any questions around the COVID-19 CARES Act or anything to do with the payments? And again, we always say talk to your tax advisor, talk to your financial planners. They'll help you kind of take a look at your individual situation and see how that might apply to you. Okay.
There are a couple questions.
Sure, go right ahead, Bree.
Okay, this one's more general. What % of monthly income do you recommend that people put into savings? I know this is probably an it depends kind of a question, but is there some kind of formula that you offer people to just give them a general sense of how much they should put into their savings, and then also for retirement investments?
Absolutely. So again, you're completely right. It does depend on everybody's household finances, right? Because if somebody is spending just to manage the house comfortably, is some may be spending $5,000 a month, others might be spending $7,000 or $8,000 a month. So it just depends on what is your percentage of income that you can also put away and not have to then turn into dipping into later on because you saved a little bit too much and now something's coming up. So when you do your financial plan and you figure out what's my income, where are my expenses, what big expenses might be coming down the pipe that I have to put more money aside for, then you can also figure out what percentage can I put in, how much do I have left over to put in on a separate savings account that I can save for a rainy day. You know, if things really go bad, if we have another pandemic, if I'm just out of a job in general, if I'm changing careers or I'm becoming, let's say, for instance, going into a new type of economic environment. Some people have changes in households, whether they're getting separated or divorced, or, you know, there's other payments to be made. Sometimes that causes a little bit of anxiety because there's a different budget now. So it would depend on how much are you bringing into the household and what percentage of that can you put away and how many months of that can you kind of put away comfortably that can catch you up to at least that 6 months worth of expenses. So for instance, very quickly, if you're looking at, you know, putting away $15,000 or $17,000 on the side, because that would be 6 months worth of expenses, break that down into your monthly income and see how much, what percentage of that is your monthly income, and that's the amount you have to put away. I hope that answers that.
Yes, super helpful. And there is one that's more related to the coronavirus. Can you address the time limit for removing money from retirement accounts without penalty that Congress has allowed recently due to coronavirus? I'm not sure if you have specifics on that or just more general info.
No, we're absolutely going to get into that as well. So we're going to actually, it's a perfect segue into the next next part of the seminar. So with that, if there's no other questions, I'll just continue because that question will be answered in the next couple of slides as well.
Perfect, let's do it.
Okay, great. So one thing that we take a look at is federal loan debt. And because of the CARES Act and what the federal government has done is for a time frame, they've actually waived the interest on federal student loans. Now, what that means is you have the Department of Education that administers certain loans, such as the federal Perkins loan, the federal family education loan. A lot of these direct loans that are from the Department of Education, they've waived all the interest. So your payment won't go down. You're still going to pay the same amount you paid every month, but instead of it going toward interest and principal, it's now all going to your principal. So you're actually able to tackle your student loan debt a little bit quickly now. The other thing is, if you find yourself in a crunch, what you can do is you can write to the Department of Education and you can ask to have your student loan actually put on hold temporarily. So it doesn't work against you. Normally, student debt is it's a very sensitive topic because it's one of those things that you just can't stop paying because it really does take a toll on your credit report for years to come. But one thing you can do is you can write to the administrative departments in the Department of Education for a forbearance, which means that you can temporarily stop making your federal student loan payments without becoming delinquent. And that's really important because on your credit loan, on your credit report, I should say, it would show that you're on time, you're paying payments on time. It doesn't show that there was any type of deferment or anything, which is a huge, huge point to point out here, because at some point when you get judged on your credit score, being on time and deferring are two different things. So if you need that forbearance, if you need that time to stop paying, you can write in and ask for that, and they are willing to do that. If you have private student loans, so you have a student loan, but it's through a bank or it's through a private lender or a commercial lender, that's something where you need to contact them. That's not to be confused with the student loan interest waiving. That's actually where you would have to talk to that loan servicer and see what they're willing to do for you. They may not waive that interest for you. They may not allow you to go months without paying, but they will work with you in most cases, and they understand what's been happening for a lot of people. So it's not a bad idea to reach out to them. One thing also that we want to go, I'm going to just touch on quickly when we go back here for student loan debt, is along with the economic relief package, there's one thing that you're allowed to do now from your IRA with your Coronavirus Act. So one thing that they allow you to do with the act is they're allowing you, if you have, let's say, expenses that were related to COVID-19, whether that means that your income was affected, there were certain bills you had to pay because of the coronavirus. There are certain times that the IRS will say, you know what, you can take money out. Generally, right now as it stands, and again, you have to speak with a tax advisor for your own individual situation, but up to $100,000 from an IRA, they will not charge you the 10% penalty, and they'll allow you to pay that tax bill over 3 years, which is huge. So for instance, you take out, and I'm again using random numbers, you take out $50,000 because of COVID, there's certain expenses that you're unable to meet. And again, what those expenses are and how you qualify, you really need to talk to a tax advisor. But let's say you qualify, your tax advisor gives you the okay to do so, you take out the $50,000, you're under 59.5, you don't pay the 10% penalty, and you can pay that $50,000 tax bill, whatever the tax bill would be from taking that money out, over 3 years. They're also allowing you, only because of those COVID-19 expenses, they're allowing you to pay that money back into your IRA over 3 years. So they're allowing you to put that money back, that $50,000 that we just hypothetically took out, you could put that back maybe, you know, $15,000 a year or $20,000 a year over the 3-year period to get back into your IRA, which normally is never allowed. Once you take it out, you do have a very short, once a year, 60-day time frame to take money out and put it back in, and they don't charge you any taxes or interest. But again, they're letting you do this over 3 years and put the money back. So that's, again, something you want to talk to your tax advisor. And I hope that answered the question that we just had. But again, it's something that you definitely have to keep your records for, and we can't kind of insist on that more, because you never want to be caught where you thought it was a coronavirus expense and they don't see it that way, and now you're stuck with a bill. So always talk to your tax advisor before you make any decisions regarding what you're going to take out, and assuming if it's a COVID-19 related expense or not. Did that make sense so far?
Yep, that's great. Thank you.
Great. All right. And if you have any other questions along that, please let us know, and we can go into that. One thing we also want you to do is, just switching topics here a little bit, is watching out for scammers. You know, unfortunately, the internet has brought us a lot of good things, apps and different things that we can use to kind of really help us manage our finances, help us manage our expenses, income, and investments. But one thing that's happening a lot now, and even unfortunately tricking savvy investors and savvy online users, is phishing scams, and a lot of scams where people are getting emails that seem to be from the institution that they may have contacted or that they may hold investments with or money with, and you're clicking on something that's creating an issue. Either it's putting on viruses, or it's creating some kind of network where they can get into your computer and your information. So one thing that we always want you to do is be very careful when you get an email, even if it looks legitimate. If you have any thoughts at all, call the institution or go online yourself. Don't log in through an app. Don't log in through an email. Don't log in through a random site you might get. Go to the official site, make sure it's encrypted, and go in and log in through there. Check on family members. You know, if you have parents who are maybe not as savvy online, or if you have older family members or friends, maybe you want to just check with them, make sure everything's okay, make sure that they've been checking their online statements. Maybe some people don't go online as much. They're used to getting their statements in the mail. Perhaps you may want to help them log online and just make sure the expenses that are coming out of their checking or savings or investments, that those are actually theirs. You know, we do want to be very careful about that. Even when you're downloading apps or files, just be very careful that that's the same one you wanted to download, and it's not one that's a duplicate that looks very similar, but it isn't. We also say, trust your gut. And if you did end up clicking on something, or you did end up doing something that you just realized right after you did it that, you know what, that's not that frame looks like, that's not what that website should look like, I think I made a mistake, call the institution right away. Go online right away. Also, please, at this point, it's very important, change your passwords often. I know it's a pain because we have like a slew of passwords that we have to remember between work and home and personal and everything else. But this, more than ever, is time to change passwords and keep everything very, very tight. So I hope that helped. So really, key takeaways was to revisit your spending plan and cut unnecessary expenses. You know, try to take a look at what's important now. Some things you can reapply for later, or you can add on later. Let's say streaming on your, because and everybody likes a show that the other one doesn't have on their device. Take a look and say, maybe we suspend it now, but we'll start it back up in a couple of months. Be proactive with lenders and loan servicers. You know, work with what you have. Work with who you've had long-standing relationships with, and see if they can help you during these times to either lower your income or your expenses. Also, make saving a priority. You know, take a look, save as little as you can or as much as you can, but also if you create a financial plan and you look at your spending, your income, big ticket items coming down that you have to pay for at some point, whether it has to be, you know, something that's $500 or something that's $5,000, make sure that that's part of your budget so you're not scrambling to figure out how to pay that, or having to take out an interest-bearing loan because we just didn't plan enough in advance. You know, take a look at keeping investments for retirement separate and make sure that those can be earmarked for retirement so we don't have to dip into those. And avoiding market reactions is huge. You know, it's always really not good to time the market, because generally timing the market doesn't really work. And in the few cases it's worked, it's just turned out to be luck. It's actually staying in the market and working with what you have and creating a plan and sticking to that plan no matter what happens. If you can keep the emotions out of your investments, you'll actually do better because you can see the long-term future of things. And then, of course, if you need any of the federal and state relief, definitely take a look at those provisions. They're there to help you. They're there for you to take advantage of if you need it. The CARES Act also gives you a lot more room to maneuver around your retirement assets than normally you would ever be able to have for yourself. And Bree, if it's okay, I think I'll just try to turn the video on one more time and see if
Yeah, let's do that.
Yeah, just in case.
That's great. I know it's always nice to see a face if we can, but the audio was very clear for the time without the video, so that's great. It did.
Good. Just making sure. But again, if you guys have any questions, if there's anything you've touched on that you want more information about, or if, for instance, you need a one-on-one consultation because there's something very specific you want to discuss and you want to take a look at how it affects you, or if you're even eligible for a few things, please let us know. We'll be more than glad to spend the time with you and talk to you about your individual situation. And again, as we get through this, one thing that FlexJobs and Prudential Insurance Companies of America want to actually really get across is not only are we worried about you as far as financially, and we want you to take the right steps and not panic, but one thing we also want you to do is take a look at your own mental well-being. If things are stressing you out, if there's anxiety about work or about finances or just in general about where the world is going, please reach out to a professional. There's so many out there who can help you get a grasp on different parts of your financial life that maybe can ease some of that stress. And we just hope that everybody's healthy and happy. And again, we'll be here for questions if you have any, or we can do one-on-one consultations. And we hope that some part of this maybe made sense to you and maybe gave you a different thing to think about and help you manage your finances and your household situation a little bit better. So thank you so much for taking the time today.
Yeah, thank you, Emily. This was so wonderful. We have lots of thanks coming in for the great information that you have here. For some, it was reassuring. For others, they learn new things. So we do have a couple more questions that I would like to throw out. And just to follow up on what you were saying, if anyone is interested, after this webinar is over and we close it down, a survey is going to automatically pop up for all attendees, which will, help you provide feedback about the webinar and also allow you to give your information if you are interested in that one-on-one complimentary wellness checkup with a financial advisor. So be on the lookout for that. That link to the survey will also be in the email that we send later this week with the recording of the webinar, so you can also fill it out then and leave your information. So a couple of questions. This actually is our number one question at the moment. As someone who's always worked for a company that took out 401k contributions, I am now venturing into the self-employed 1099 category. What is the best way to manage or automate contributions on my own?
That's a wonderful question. So for self-employed individuals, there's a lot of different retirement accounts that you can take advantage of as a self-employed person, depending on how you're set up, how your company is set up. If you're a 1099, you could still talk to your tax accountant and double check and say, does a SEP IRA work for me where I can save 25% of my income up to $50,000, whichever's left? Or do I set up a different type of retirement account depending on how I'm set up with my business and my taxes? And once you do that, your accountant will generally give you a dollar amount that you can save in any particular year, depending on your taxes and your income. And you can go ahead and save that. So for instance, if you're getting paid into an account, let's just say you have a business checking account and that's where your income's coming into, you can set up a bill pay to go directly into an IRA somewhere else. Maybe it's in the same institution, maybe it's a different institution. And that's almost like a direct deposit from that checking account where you're getting paid from your customer. And you can take that money and automatically every month, let's say if it's $6,000 a year that you want to save into this self-employed retirement plan that you've set up for yourself, you can take $500 a month and automatically schedule that as a bill to go in, and you set it up as bill pay so that it turns into a contribution into your IRA. And there's many ways to do it. Most financial institutions from a retirement account set that up for you and say, can we set this up for you? Can we go ahead and move a monthly amount in, a quarterly amount in, a semi-annual amount in? Some self-employed individuals will do it on their own. They'll send in a payment to their retirement account when they can, when they feel necessary, when their accountant tells them how much exactly they can save into that retirement account. For others, they use the financial website platforms to go ahead and pull money every month or every quarter, whatever's easier, depending on how you get paid and what's convenient. And then they may add additional payments and bring them in as contributions when they can. So a lot of it can still be very automated. But then there has to be some caveats depending on how much your limits could be in those certain types of retirement accounts. So great question.
All right. And we have one maybe quick question here just to clarify some of the things that you were talking about. This is our last question for the webinar, but it's one that a lot of people had. If you have multiple cards with balances, credit cards with balances, do you recommend paying off the cards with the smallest balances first or paying off the cards with the highest APR first? Is there an answer to that?
That's a wonderful question. In general, again, it would depend on your situation, but in general, we would like you to start attacking the ones with the highest annual percentage. Again, if you have some cards that are only charging you, and again, just using general terms, 10% or 12%, and you have other ones that are charging you 25 and 30, but you can clearly just very quickly clear up those balances on those smaller cards. Maybe it's, you know, $1,000 or $1,500, something small. Do that because it does help your credit score because it shows that you're using less of your credit. So you can ease up a little bit better on your credit reporting because it looks like you're not using as much of credit as you have. However, we do want you to aggressively attack the credit cards that have the highest interest because, again, those are going to be the hardest ones to catch up on. And the amount of interest that they're charging you on that, unfortunately, can add up pretty quickly.
Absolutely. Well, thank you very much. I know I threw a lot of questions at you and you had already provided lots of great information, so I appreciate even more detail. Thank you very much for being here.
Oh, it's completely my pleasure. And again, thank you all for being here. And to all of you, Bree, thank you for everything. And Desiree and Dawn and FlexJobs in general for letting us give you this information. So it's great.
Absolutely. And thank you all the attendees who are here today. You will receive an email later this week with a link to view the recording, and the survey will pop up right now when I click end webinar, but it will also be available in that email so that you can fill it out then as well. So thank you all, everyone, and have a great rest of the day. Bye-bye.
You too. Take care. Bye-bye.